Thank you so much, Aditya. I hope the audio is, marginally better than it was earlier.
Yes.
And I do hope to, Vishaka made a very compelling case for insurance, and I hope to do half that job at least with NPS. So thank you very much once again, Aditya, and the entire eQualified team for inviting me to this session. I'm holding up my mic, so you must be wondering why I've put my hand up, just to make sure that the audio is clear. So thank you so much, and I'm delighted to be actually representing the industry, more than HDFC Pension Management Company, which of course I lead. I'm here as a spokesperson for the pension management industry. Not an authorized spokesperson, but somebody who is going to speak on behalf of the pension fund industry. So my focus is really going to be on the background to this product specifically, which is NPS, as you pointed out, Aditya, and a lot of things that are not known about NPS. And I'll tell you why. I think I chose to title this presentation as NPS, the Next-Gen product, and I'm sure a number of people in this very august audience, which I'm sure is full of sophisticated wealth advisors and wealth managers. I myself have, in my past avatar, have been associated with the wealth management industry for over 15, 17 years. So I have a tremendous amount of respect for people in this industry, and there's a lot of very, very good work that this fraternity does for the Indian investors. As we all know, the financial literacy levels in India are fairly low. So I think this industry does a huge amount of work to make sure that people make the right kind of investment decisions. So thank you very much to all of you. My job today, at the end of this 20-25 minutes that I'll hopefully take, and then hopefully leave a few minutes for Q&A, is to essentially leave with you a very strong impression of why this product is, in my opinion, a next-gen product. And I'll share some statistics and I'll share some background data. And having spent a fair amount of time in the wealth management industry, I must confess that when I was in the wealth management industry, my understanding of NPS was abysmally low. And I won't be surprised if it is low across this audience as well, because of the fact that that's the nature of this business. That's the nature of the way we run our business, right? So I'd like to therefore begin by giving a little bit of a background. And before doing that, I really want to get into really defining why we are doing what we are doing. And so this is the flow of the presentation. I'll share the background of this product. How did this come about into existence? What is the architecture? And what has been happening over the last, a few years that this product has been in existence? It's almost 2 decades since the product was launched in 2003, beginning of 2004. What has been the history of this product, and why it makes a compelling case for each person on this in this forum to understand this product in depth and make sure that you're utilizing this product to deliver a superior product to your clients as well. So that's really what my objective is going to be. But before doing that, I want to dwell on the subject of why NPS, right? I mean, and most of the times the question is this something that I even should be interested in? Because the commercials on this are not worth my time, and that's something that I hear a number of advisors talking about. But I will try and make a case for why it is absolutely important for you to take this product very, very seriously. We're at a very nascent stage, but I think this is a product that deserves a tremendous amount of attention. And I think if you can allocate this as a part of your clients' portfolios, I think they will thank you 10, 15, 20, 25 years from now. Now, let me begin by getting into a familiar topic, right? And I don't want to preach to the converted, but most people in this audience will know the answer to this question, right? What drives long-term return? We all know that these are the 3 things that really drive market, long-term returns as far as any financial product is concerned. One is market timing, the second is security selection, the third is asset allocation. But we also know that a tremendous amount of time is spent on item number 1 and item number 2. Very little time is spent on item number 3, which is asset allocation, right? And the reality is that, and this is a research that was done by 3 professors from the University of Chicago, and the conclusion that they came to when they looked at pension funds, incidentally, over 34 years, was that 93% of long-term returns were determined by asset allocation. So asset allocation is really the linchpin for long-term return generation. I know I'm preaching to the converted. We all talk about asset allocation being the most important element when it comes to long-term, wealth creation. But unfortunately, whether it is practiced or not is a question that I don't have an answer to. I will reserve my judgment, but more often than not, I see that whether we like it or not, the investor tends to spend a lot more time in market timing and in security selection, right? Why is this relevant, and why, and what are the other things that are important? What else drive long-term returns? Very simple: cost, taxes, risk management. Are you managing the risk in the right way? Is there a governance around it? Is there adequate diversification? Are you looking at volatility? Are you looking at asset allocation? Asset allocation, of course, is, in terms of diversification across asset classes, also forms a part of the risk management bucket. But above all of this is this, right? Which is patience, which is more behavioral than number led, right? So time in the market being more important than timing the market is something that all of us have heard enough number of times. But I think that really underpins long-term return generation, long-term wealth creation, right? Why am I talking about all this? When I'm referring to this product called National Pension Scheme, or NPS, right? What is and this is a perception that I see of NPS, right? More often than not, when it comes to NPS, these are the things that comes to people's mind. I don't want to lock my money for long periods of time. There is this perception that the money, when it's invested here, gets locked in. This is meant for retail investors. This is not for me. I'm an HNI investor. Why should I bother about NPS? Right? This is a 50,000 ATC product, right? 50,000 रुपए डालना है, तो ये product के अंदर डालेंगे. Otherwise, who would bother with a 18,000 rupee tax break in a year? 50,000, not so important. Therefore, it gets ignored. It's a cumbersome process. I'm sure, opening an account, NPS account, or a PRAN account as it is called, is a cumbersome process, potentially low annuity rates. And I heard, Vishaka speak about, annuity. There is this perception, widely held perception, that annuity rates are not very attractive. And then, of course, from a distributor perspective, the distributor commissions are low. And these are some of the perceptions, and I will try and bust some of these myths. Some of them are myths. Some of them are product features, which I think are actually strengths or pros rather than cons, right? And I'll try and address each one of them. Now, there is one product that addresses each one of these, and that, by the way, is NPS, right? And when you look at each of these 6, elements that I've spoken about here, the first is taxation. This is the only product that has an exempt status, right? The only other product that has an exempt status is obviously Provident Fund. But the limits here in terms of investments are significantly higher than what you can potentially invest in a Provident Fund. The second point, which is with respect to risk management, this is a business where the universe of securities that one can invest in is very tightly defined, right? In India, and this is governed by the Pension Fund Regulatory Development Authority and the NPS Trust, which is essentially oversees the investment activities of pension fund managers. The entire universe is very tightly defined. So the top 200 stocks is the only stocks that that a pension fund manager can invest in the E category, which is referred to as the equity category. In the corporate bond category, over 75%, over 90% has to be above AA in terms of rating. In reality, most fund managers in the pension fund space have more than 75 to 80% in AAA securities, right? So that's the kind of risk management universe or framework or boundary conditions that is being defined by the regulator. Thirdly, and this is something that will, resonate with a number of you on this call, which is essentially, what are the fund management charges? So the fund management charges here are 3 bips to 9 bips. And I want to reiterate this, 3 bips to 9 bips, which is 1/10 or 1/20th of what you would essentially pay in an actively managed fund. And I'm referring to, of course, mutual funds. And I don't intend comparing apples and oranges, but the reality is that this is also a fund which is actively managed. And I will show you the returns from this funds, and therefore that will shine the light on why I believe that at a fraction of a cost, you are getting access to some of the best fund managers, and the total fund management charge therefore is between 3 and 9 bips, of course, including other charges, allied charges that would be there. It would add up to not more than 15 to 17 basis points a year. So that is the total cost that you pay. And we all know, as practicing professionals, that one of the biggest leakages that can happen over long periods of time is cost. And this is something that this is the cost angle that I'm highlighting, which is essentially the cost of managing the money. 15 bips overall, 3 to 9 bips is the fund management fee. The fourth, aspect really addresses the behavioral issue that we see with most investors, which is to say, when the markets are jittery, we've all seen this. It probably didn't happen as much in March 2020 as it happened in maybe 2008. We all, those of us who've been in the industry for long enough know that in 2008 even the most sophisticated investor bolted for the door. And the same happened in some smaller measure, maybe in March 2020, when the markets corrected by 39% within a matter of a month. But of course, the market rebounded with a vengeance, right? But the reality is that irrespective of whether the market is volatile or not, there is this constant urge or the itch that the customer has to, continuously keep making changes to asset allocation. This is a product where for most investors, you really do not need to do anything. All you need to do is put it in what is called as an auto choice investment option within NPS. It will automatically change the asset allocation as the age of the investor progresses. You don't need to do anything. All you need to do is choose the auto choice option, right? So that's again is, in my opinion, a very futuristic feature that is there in NPS as a product. Fifthly, this is the only product where an external agency, and let me tell you, there are two agencies. One is the Pension Fund Regulatory Development Authority and the NPS Trust, which is again a regulatory body. These are the two bodies, and this is, of course, the NPS Trust is a subset of the PFRDA. These two bodies are responsible for monitoring the performance of every pension fund manager. So every quarter, every single pension fund manager's performance is monitored, reviewed on a quarterly basis. While this may be a 25, 30, 35-year product, given the nature of the monies, the reality is that this gets monitored and the fund managers are reviewed every single quarter by an external independent agency. I don't know of any other product where this happens, right? Finally, this is a very, very digitally, this is a product which is entirely digital end to end, right from onboarding, which is, and this is right from day one. This has been the case right from day one, where it takes less than maybe 7 or 8 minutes for you to generate a permanent retirement account number, as it is called, the PRAN number, as it is called. And at the time of exit and withdrawal, the entire process, right from the money coming back to the investor's account to the money getting sent to the annuity service provider, everything happens online, fully digital, right? And even the overall and the entire servicing, during the course of the investment also happens completely digitally, right? So it's a product which is fully digital. It's a product which has got some very, very strong positives, right? Now let me come to, so what has it done in the last, maybe 9 years that, some of the pension funds that have been around, most of the private pension funds have been around for the last 9 to 10 years. And the returns that one you will see here, and maybe the fonts are a little small. HDFC Pension, of course, tops the charts in 3 years, 5 years, 9 years since inception. We've been right at the top in terms of returns delivered under the E category, which is the equity category, the C category, which is the corporate bond category, and G category, which is the government securities category. Across the industry, and of course, the differential across different players is not very large. HDFC Pension tops the chart, but across all players, you've seen some exceptionally good performance, right? So if you look at 3-year returns, it's in the region of 15%. And these three tables that you see are the tables for the aggressive investment choice, which is 75% exposure to equity, moderate or balanced investment choice, which is 50% exposure to equity, and conservative investment choice, which is 25% exposure to equity. So across all three categories, you will see that the returns here are higher than the other competing, pension products, so to say, or the retirement products, so to say, which is, the provident fund or the employee provident fund and the pension, public provident fund that you have. So this is a market-linked product which can create significant wealth for clients over long periods of time. Now, mind you, this does not take into account the fact that this is just product level returns. Now, if you were to take into account the exempt status at the time of investing money, the returns would be accelerated by another 30 to 35%. So the actual returns on this product is 1.2 to 1.4 times higher than what is shown here if you take the tax impact into account and compare it to a like-to-like product, which I will do slightly later in this presentation. Now, unfortunately, despite all of these, in my opinion, this is a space age product. The kind of features that are built into this product are really, really top of the line. Despite that, the adoption has been very, very low. And we know why it is low. The reason why it is low is that, unfortunately, the commercials on this product are not very competitive. And therefore, we see that this product is by and large, falls at the bottom of a wealth advisor's choice. My appeal to you, and these numbers are a telling example of what is the extent of penetration that has really happened, right? So if you look at the corporate sector and just focus on the two tables at the bottom, the left-hand table talks about the number of subscribers, the right-hand table talks about the number of, the AUM. In terms of number of subscribers, there are only up around 37 lakh subscribers across corporate and unorganized. Unorganized is really the retail segment. Even within the corporate, there are close to 5.5 to 6 lakhs, which are banks. Banks are mandatory. Banks NPS contribution is mandatory. So if you look at voluntarily, people who have voluntarily chosen to buy into NPS, that number is a very, very small number of around 30 lakh unique subscribers. Compare it to the maybe 3.5, 4 crore. I think it's around 4 crore of mutual fund investors who are there, individual mutual fund investors that are there today. This is less than 1/10 of the number of mutual fund investors that are there. Yes, the industry needs to do a lot more. We as an industry, the pension fund industry needs to do a lot more to publicize. And that's one of the objectives that, I was happy to accept this invitation and hopefully make an impression on all of you to look at this product more seriously. In terms of AUM, the number is even smaller. Less than 17% of the overall industry AUM belongs to the private sector. The remaining 77% in terms of number of subscribers and the remaining 83% in the form of the AUM is from the government sector, which is the government employees for whom the old pension scheme got replaced by the new pension scheme in 2004, and from 2004 onwards for a number of state governments. So majority or the bulk of the 7 lakh odd crore of AUM that is there in this product belongs to government employees. And therefore, so as an industry, as far as the non-government sector is concerned, I think there is a huge opportunity that is available. And each one of you on this call can make a significant impact for your clients if you were to understand this product, deeply, and if you were to take this product, seriously, and promote it amongst your clients. Because I genuinely believe that this can actually change the lives of people in India, especially in a country like India, where social security does not exist in any form and shape. Moving on, as I said, this was launched in 2004. April 2004 is when it got launched by the government of India. So it is a government of India product, right? And as we speak in 2022, June 2022, we have close to 1.6 odd crore of subscribers, out of which only 30 odd lakh subscribers are the non-government subscribers. The other point that I want to make is that Indian pension fund assets under management is less than 3%. Now, global averages there are countries where it is upwards of 100%. Even other developing countries have GDP as a share of the GDP, it's upwards of 8 or 9%. So we are really, really, at a very nascent stage in the industry. And therefore, there's a lot of work that we need to do to make sure that we are able to create significant financial security for our aged population as time progresses. Moving on, this is the architecture. I don't want to take too much of time. Broadly, there are, within a pension fund, within the pension fund industry, there are 3 or 4 broad, sets of people. One is the pension fund manager. So HDFC is the pension fund manager. Apart from being a pension fund manager, it also is in the business of acquiring new subscribers or helping people set up their plans. They're referred to as the POPs. And then once the account is set up, then the account management, of course, happens by the pension fund manager. There are other entities such as the CRA, custodian, annuity service provider is the person who actually supplies the annuity at the time of maturity of the product. I don't want to take too much time on these, but just to give you a high level view of who are the other people in the architecture. The best of the names are there in this. As we speak, there are 7 PFMs which are active. The 3 public sector PFMs, LIC, UTI, and SBI funds, SBI pension funds. These are the 3 public sector fund managers. The government monies, by default goes to these. Government employee money by default goes to these 3 pension fund managers. The other 4 are private sector fund managers, which is HDFC, ICICI Prudential, Kotak, and Birla. 3 more have got licenses now, and you're going to see a lot more action as time progresses. Within this, I spoke about this earlier: equities, corporate bonds, government securities, and alternate investments. So these are the 4 categories in which a pension fund manager can invest. There is an active choice option for the investor. There's an auto choice option for the investor. both of these choices. So auto choice is for somebody who doesn't want to go through the process of making asset allocation changes. So the auto choice actually offers you three types of funds: the aggressive fund, the moderate fund, and the conservative fund, based on which the equity allocation happens. And as time progresses, the allocation to equity keeps going down as the age increases. And then, of course, there is the active choice option, where the investor can choose to deploy a certain amount of money in equity, as per his choice. And of course, the allocation will keep coming down. Even in the active choice, the allocation will keep coming down once the age of 50 is crossed. And these are the three models that I spoke to, which are the auto choice models, which is essentially the 75% equity allocation, 50% equity allocation, and 25% as equity as allocation. And then accordingly, the other two allocations go up as time progresses, right? So these are the three. And post the age of 35, the allocation from equity keeps coming down, and that keeps getting allocated to corporate bonds and pension funds. There is tier 1 and tier 2. Tier 2 is a simple. Tier 1 is the one where you have a tax advantage. Tier 2 is where you really use that as very similar to a mutual fund account. Again, you could look at this as a actively managed mutual fund with a 4 to 5 bips kind of a cost. Taxation on this, of course, it's open to interpretation, but and you should consult your tax advisor. But our interpretation is that this is treated as capital gains from tier 2 is treated as akin to debt, which is 20% post indexation after 3 years, and therefore it can be a very, very compelling case even if you look at it from a tier 2. Tier 2 at this point of time, the industry is very, very small. Most of the investment happens in tier 1. Moving on in the interest of time. So, across all of these, there is a tax-free amount withdrawal. And of course, there are technicalities in each of these. I don't want to get into it, but all I'm trying to say is that there is a very strong tax advantage that is obviously available, but that is not the only thing, right? And when you look at how this is structured, if you were to look at a corporate NPS, and corporate NPS is something that, as I said, there are around 14 odd lakh, subscribers there. 10% of the basic of the individual can be allocated towards NPS. This is capped along with superannuation funds and employee provident fund contribution at 7.5 lakhs. So for an individual with, let's say, a 25 or a 30 lakh, let's say somebody who's got a 20 lakh basic, up to 7.5% of 10% of that, up to 7.5 lakhs can be invested in NPS. Here, as you can see, on 20 lakhs, there is a 2 lakh that is invested in NPS, and you make a saving of the entire 30% on the 2 lakhs, so 33.5% on the 2 lakhs, and therefore you end up making a saving of 75,000. So if you were to take this into account and then compare it to the comparative products that are available to you in the market, and as I was saying, this is a very, very simple product process. The process of onboarding is very, very simple. It just takes less than 10 minutes for you to open the account. So corporate NPS, significant tax advantages. I will also share with you how that actually reflects in terms of the outcome. The entire ecosystem, as I said, is digital. The entire onboarding process, contribution process. In fact, in tier 2, there is something called a deremit facility, where you put in money before 10 o'clock in the morning, you get the same day's NAV, right? So those are the kind of features that are available. Unfortunately, not very well understood or known, but across the entire steps of this product, everything is completely digital, right? From onboarding, contribution, servicing to withdrawal, everything is completely digital, right? Now, comparative returns. I know this may not be a very popular slide because I'm sharing a comparison with mutual funds, but the reality is that if you take into account the impact of the tax advantage that one gets upfront at an exempt status right from the beginning, and if you take into account the fact that the entire withdrawal proceeds are free of tax, there is no tax that is levied on the entire withdrawal proceeds at the time of maturity. Of course, 40% of this corpus has to go towards purchase of an annuity. An annuity is a product where your returns are guaranteed for the rest of your life, of the life of the subscriber, right? Which is in itself a very powerful feature. If you look at it today, the annuity rates that are available today are in the region of 6.5, 6.75%. That is the rate that this investor will get if you buy an annuity today, even 20 years from now. So there is actually, of course, is there a provision for the rate to go up? Of course, as the interest rates in the market go up, this will go up. This rate is also a floating rate. But once you lock into this rate at the time of buying an annuity, you're locked into this rate for the rest of your life. There are other innovative features. Vishaka was mentioning some of those, where she spoke about inflation-linked annuity. Those are things that those are other developments that are happening. But the reality is that this product, and if you were to look at the last column, which is the NPS column, the impact in terms of the total sum total that you make, including your one is of course the tax-free withdrawal amount, and then subsequently the annuity that you get from it, and you assume that the person survives till the age of 85, the impact or the differential between this product and the other products that have been put on the table here is dramatic. And I think this is not very well understood. And I think it is important for you to take cognizance of this. And by the way, on the mutual fund side, we've actually compared this with hybrid funds because, NPS, the product that has been taken here is a 75-25 allocation between equity and debt. So we compared it with the basket of hybrid funds, which are about 5,000 crores of, assets under management. Now, finally, this is an actual case study. This is an actual case where, for 115 months of contribution, this investor, as we speak, has seen a return of 11%. Now, this 11% to you may sound like a, not so exciting number, but keep in mind that the allocation into equity in this is only 42%, which means that if you were to look at it from a risk-adjusted perspective, the Sharpe ratio of this is very, very high, right? And if you were to take into account the tax advantage that this investor has gained through the course of the investment of this individual, the effective rate of this portfolio, which has got 42% in equity, has delivered a 16% effective rate if you were to compare it after taking into account the tax advantage. Now, you want to make a difference. These are the ways to make a difference. If you have an individual or a corporate ARN, you can potentially align yourself with us or with any of the other POPs that are there in the market. And then, take this wonderful product. In my opinion, one of the best products to create long-term wealth because it actually forces you to stay locked in. And Vishaka spoke about the importance of discipline. This is a product that will keep you disciplined and invest your monies in a market-linked product. 25, 30 years, there is absolutely no way you will not make a double-digit return if you have the right kind of allocation to equity in this product and create a significantly large corpus. And of course, there is an SIP option available here as well. And therefore, create a reasonably neat kitty for your clients. So with that, I'm going to stop, Aditya, and leave the floor open for any questions that may be there. Thank you.